How's everybody doing? Welcome back to another episode of the Banker Next Door. I'm your host, Dr. Joe Berquist. Today, I wanted to talk to everybody about loan demand and business activity for the third quarter of 2024. Like, how are things going? What's happening? What can we kind of expect to see going on, perhaps heading into the fourth quarter here? So I want to share two things with everybody today. The first up is, I'm going to bring this up here real quick. So the first thing is an article with S&P Global Market Intelligence. And the second thing is the New York Federal Reserve. They have basically a business activity report, basically a business leaders survey that they put out, just to give us an idea. Is kind of like what are they seeing, kind of what's going on in their world. So let's get in here to this article here from S&P Global Market Intelligence, which basically says Quarter three bank reports to show weak loan growth and modest deposit improvement. So weak loan growth is posing a headwind once again as U.S. banks get ready to post third quarter results, with hopes still hanging on rate cuts to spur credit demand in future periods. Loans across domestically chartered U.S. banks inched up just 0.4% from June 26th to September 25th, according to weekly data from the Federal Reserve, and were up 0.5% after seasonal adjustments. So bank credit growth has been anemic for more than a year, with total outstanding loans and unused commitments across the industry up just 1% from the year prior at June 30th, according to semi-annual data compiled from S&P Global Market Intelligence. So loan growth outlooks could be at risk, Piper Sandler analysts said in a September 23rd note previewing third quarter reports, reflecting the impact of high interest rates on demand, banks focusing on cultivating full client relationships instead of just lending, and caution in an election year. Meanwhile, deposit growth has been modest but steady, hovering near 1% to 2% year over year since late March, according to the weekly data, with deposit growth of 0.7% from June 26th to September 25th. After seasonal adjustments exceeding loan growth, banks have been adding modestly to securities holdings. So, and then there's a kind of a chart here showing securities, loan and lease losses, cash assets, deposits, large time deposits, and borrowing, mainly from Federal Home Loan Bank lines of credits, things like that. You can see kind of borrowings are down here, kind of been decreasing. Securities percentage change, securities up just a little bit. But loans and leases, very, very anemic. Cash assets have been dropping for the most part. Deposits, again, very anemic on the deposit front. Large time deposits, a little bit of uptick there, but then also some downtick too. So, and then again, borrowings, pretty much down. So, and then it basically gets into largest U.S. banks and unused commitments, and then, unused commitments for credit card lines at U.S. banks. And then rates and vibes. So banks have already pulled back on loan growth guidance this year after sometimes setting optimistic expectations for the second half. Senior executives have offered somewhat varying conjectures over the reasons behind weak credit demand. At a conference in September, Truist Financial Corp Chairman and CEO President William Rogers Jr. emphasized the role interest rates played, saying that business owners probably do not arbitrage elections, and that while borrowers had capitulated to high rates 6 months ago, they are now looking for cuts to spur the economy. Wells Fargo and Company CFO Michael Santomassimo said that in addition to cuts, the election is an uncertainty inhibiting confidence in a soft landing. Bank economists do expect lending activity to firm over the next 6 months because of falling interest rates. An American Bankers Association advisory committee made up of 15 senior economists at large banks projected in September that commercial and industrial loan growth would be 3.3% in 2025, up from an anticipated contraction of 0.2% this year, and that consumer credit growth would increase to 3.8% from 1.9%. Credit card lending slowed in the third quarter, but remained ahead of lending overall on a seasonally adjusted basis at 1%. And then unused consumer credit card line growth across U.S. banks slowed to 2.4% year over year at June 30th. So, and I think that's kind of it. Yeah, that's kind of it on the lending front in this article. But I just want to say here, credit card lending is at an all-time high. And I don't think we want credit card debt to stay there. I think we want to see that credit card debt. I think it's sitting at like $1.5 trillion in credit card debt right now. I think we need to start to see that debt come down a little bit. I think that's a lot of credit card debt for Americans to be servicing every single month. That's some big dollars right there. And I can't imagine that there's not a tremendous amount of stress on a lot of people to pay those bills, But here's my take on it. I know we just talked about here some of the comments from a few of the CEOs, from Truist CEO and Wells Fargo CEO. Truist basically saying he thinks it's all interest rates. Wells Fargo guy saying I think it's the election. So I think it's actually three things. I think it's interest rates. I think it's inflationary factors, and I think it's the election. One of the things I think we've noticed here, and particularly in the last few election cycles, is that I've seen this over definitely the last three election cycles, is that there is a tremendous amount of uncertainty because of, you have parties now that have very different views on how things, should be run. And it's not like it used to be, 20, 30 years ago, when both parties were really, maybe not so far apart on business issues, or maybe one wanted to increase taxes a little bit or wanted to decrease taxes a little bit, or, it was usually more like social issues, foreign policy, things like that were usually more where like the divide was. And generally, I think you kind of got somewhere in the middle in terms of like, being, pro-business, tax policy, that kind of stuff. Because again, both sides really wanted to kind of, be the champion of small business, be the champion of the middle class. I don't know that that's so true anymore. And I think that's a big part of the problem. I think one party is really all about the middle class and reducing taxes, and I think the other party is really all about big business and increasing your taxes. And I'll let you can figure out who that is. But I think that because you have that divide, especially these last three election cycles, I think that that the uncertainty there, it puts people at unease. I mean, we talk, if you ever watch CNBC, they'll talk about all the time about how the market does not like uncertainty. And, and we're seeing that playing out right now. So basically the market does not like this uncertainty. Consumers, business owners do not like this uncertainty. And they're going to sit tight on big purchases, any big projects. They're going to sit tight on that for a little while until after the election's over and they know basically who's going to be in the White House in January, and then they'll kind of proceed from there. So I think the election is a very big thing, but I also think just as equally important is the higher interest rates right now. I think the inflationary pressures, which have just increased the cost of everything across the board, and are quite frankly are going to continue to increase costs across the board. Inflation might have come down a lot to like 3-4%, but look at I mean, food prices haven't stopped going up in 3 years. I mean, they just continue to go up and up and up and up. Some things that you buy are up 30%, 40%, 50%. I think we're moving toward a crisis in insurance, all types of insurance, homeowners insurance, auto insurance, business insurance. Just with, the environmental disasters, insurance companies not wanting to be in certain states, cover certain types of properties and things of that nature. I mean, I just think that we're all eventually going to pay the price for all of those things as they continue to play out, and we're going to pay the price in terms of much higher insurance premiums and companies being much quicker to drop you should something happen. So, but anyway, that's my take on that. So okay, so give me a second here. I need to get out of this, and I need to go to my other screen and share this. Aha, here we go. Okay, so this is the Business Leaders Survey. So the New York Federal Reserve basically says business activity is flat in early October. So business activity was little changed in New York, northern New Jersey, and southwestern Connecticut service sector in early October, according to the Federal Reserve Bank of New York's Business Leaders Survey. Some of the highlights include employment continued to grow slightly and wage increases were moderate. Supply availability was steady. Input price increases were slightly higher than last month, while selling price increases were somewhat lower. Capital spending picked up. And okay, now we'll look at this report in a little bit more detail here. This isn't a big report. It's only like 5 pages, but they have some great charts and graphs in here. And we're just going to kind of hit the headlines, if you will. We're not going to run through this thing, but let me just read you this one thing here. It says this big business activity remained steady and employment grew slightly in the New York, Northern New Jersey region service sector in October. Optimism about future conditions continued to improve, but remain subdued. So, and then we see here, like, activity continues to hold steady. Employment growth remains sluggish. Optimism remains subdued, to say the least. So let's look at some of these charts here, which I think are good. So business activity, you can see the 0 is the line in the middle here, the black line running right across the screen. Green is kind of the activity going up and down. And you can see here we're basically about 0 as far as business activity. So very muted business activity. And then this is current indicators, change from the preceding month. So again, business activity kind of flat, not really anything going on there. And then here's the probably the big one, the business climate. You can see they are about 25 basis points below 0. So negative 25 basis points. So that basically tells you that and you can see the unfavorable over here, 63% or 36 in September, 40% in October. So, people are not happy right now with the business climate. Number of employees, just a little bit up, slightly up, but not by much. Wages actually coming down. If you go back to 2023, I mean, you were up to 60, but now they're back down to like 30. Was it 30.6? So wages actually coming down a little bit there. Current indicators continued. So prices paid for things have come down. You can see over the last couple of years that, prices paid for things, again, like an inflationary thing. Prices received hasn't really, and this is your problem. Prices paid versus prices received, not, you're getting less, but spending more. Capital spending. Yeah, not really much capital spending going on at the moment. Supply availability still, basically running at about 0. So not really a whole lot, again, going on there. And then here are some forward-looking indicators. This expects 6 months ahead. So business activity is expected to pick up a little bit, not much. The business climate, they're saying, is going to bounce back. Maybe. Depends on who gets elected. Number of employees still kind of sluggish down here, and then but they're proposing a kind of a little bit of a spike up in wages there, which is kind of interesting because number of employees is kind of it's kind of down, but they're expecting another potential spike up in wages there a little bit in the next 6 months. So kind of interesting. And then prices paid, again, you can kind of see a little bit of a spike up there. Prices received, a little bit of a high, slightly higher than prices paid, little spike up there. Capital spending, they're expecting it to go up. Again, I would say it depends on who gets elected. And then supply availability, look at that. They're really expecting that to go negative. The Business Leaders Survey began asking about expected supply availability in May of 2024, and they're expecting it to like nosedive. That's interesting. That's very interesting. So I'm just going back up here to see if there's any activity. 28% of respondents reported that conditions improved over the month, and 30% said that conditions worsened. The business climate index was similar to last month at negative 26 points to an ongoing worsening business climate. So, yeah, I don't know. That's interesting. That supply one is interesting, and there's not really much commentary on that future supply number. So we'll have to, keep an eye on that. So, but I think I think the basic gist here is that loan demand was very weak for the third quarter. And there's, again, like I said, there's a number of factors for that. Obviously, the election, big one; higher interest rates, big one; inflationary pressures right now, and then all three of those things kind of roll down on all of all those economic activity things that we saw in the Business Leaders Survey there from the Federal Reserve Bank of New York. But I think it's good. I mean, you can't necessarily project out those numbers across the rest of the country per se, but I think it's just good because it just kind of gives you a general idea of like what's going on there. Definitely in the Northeast, but what could be going on as well in other parts of the country in addition to that. So, but I think, like I said, I mean, loan demand is weak, and unfortunately, I think we're going to have to wait another 6 months here till the election's behind us, until interest rates come down a little bit more, and hopefully inflationary pressures continue to ease. If those things happen, I think that business activity will pop up. I think it will. I think we will see some increase because people have to do things. People can only put things off, but for so long. If you need new vehicles, you can only put that off, but for so long. If you need inventory to basically continue to sell a product and keep rolling, you can only put off those inventory purchases, but for so long. You wait for, again, you try to wait for the demand to pick up, but again, you have to, at some point, you have to do things to keep your business rolling, right? But that's kind of where we're at right now. I'm hoping that maybe gives people a little bit better understanding as to what's going on kind of in the lending market right now. What's the appetite out there, and what's kind of going on with some of the business activity. But with that, I will wrap this episode up and basically say, if you like this episode, please make sure to like, share, and subscribe, as that always helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below, as I always love getting back to everybody. Make sure to check out some of the other content on the channel, and I will see everybody again real soon. Thanks a lot.